Major banks are quietly but decisively moving into physical silver near the $72 level. And while the headlines focus on price action, volatility, or speculative enthusiasm, the deeper story unfolding beneath the surface points to mounting structural stress inside the futures-based pricing system that has governed silver markets for decades. What appears at first glance to be aggressive positioning or routine balance sheet adjustment increasingly resembles a forced response to tightening physical availability, rising delivery risk, and weakening confidence in mechanisms that rely on paper liquidity to mask underlying scarcity. By the end of this analysis, it will become clear that the current move by major banks is not about chasing momentum or expressing a bullish view, but about managing exposure inside a system where the margin for error is rapidly narrowing. And the question investors must now confront is whether the price of silver is reacting to fundamentals or whether the system that sets that price is itself beginning to fracture. To understand why this moment matters, it is necessary to revisit how the modern silver market is assumed to function and why it has long been treated as stable despite repeated warnings. For most participants, price discovery in silver is believed to occur efficiently through futures markets, particularly through COMEX, where contracts represent claims on future delivery rather than immediate ownership of metal. This structure has been justified on the assumption that the overwhelming majority of contracts will be settled in cash, that physical delivery requests will remain a manageable fraction of open interest, and that inventories held within approved warehouses, supplemented by global arbitrage flows, will always be sufficient to meet obligations when delivery is demanded. For years, these assumptions held, reinforced by relatively subdued industrial demand growth, ample above-ground stocks, and a financial system comfortable with leverage as long as confidence remained intact. What is changing now is not a single variable, but the interaction of several pressures that undermine those assumptions simultaneously. Physical inventories registered for delivery have declined steadily, not as a temporary fluctuation, but as part of a longer-term drawdown that reflects structural deficits between supply and demand. Industrial consumption has expanded into areas where substitution is limited, while mine supply has struggled to respond with meaningful growth, leaving the system increasingly dependent on existing stockpiles. At the same time, financial participants who once treated futures contracts as interchangeable with physical exposure are beginning to reassess counterparty risk, delivery certainty, and the cost of being wrong in a market where liquidity can evaporate quickly. The result is a system that still appears orderly on the surface, but one where stress is becoming visible to those closest to the flow of metal. The significance of major banks entering the physical market at elevated prices lies not in the act itself, but in what it implies about their assessment of risk. Institutions that have historically relied on derivatives, hedging structures, and internal netting to manage exposure are now accepting the higher costs and logistical complexity of physical acquisition. A shift that suggests concern not about price volatility alone, but about the reliability of paper claims in a tightening environment. When entities with privileged access to data, settlement flows, and client positioning begin to prioritize metal over contracts, it signals that the internal calculus governing the system is changing, even if public narratives remain reassuring. The question that follows naturally from this observation is not whether silver is expensive or cheap at $72, but why the guardians of the existing structure appear increasingly unwilling to rely on it, and what that means for the market as a whole if confidence continues to erode. To place the current situation into proper context, it is essential to look back at prior episodes when markets built on leverage, confidence, and assumed liquidity began to encounter constraints they were not designed to absorb. History shows that systems dependent on fractional availability function smoothly until demand behavior changes in ways the underlying structure cannot accommodate, at which point stability gives way not gradually but abruptly. In precious metals, the most frequently cited parallel is the late 1970s and early 1980 period, when silver transitioned from a relatively obscure industrial input into a focal point of monetary anxiety amid inflation, currency instability, and geopolitical uncertainty. At that time, rising prices were not merely a function of speculative enthusiasm, but a reflection of eroding trust in paper claims and fiat systems more broadly. A dynamic that forced authorities to intervene once price discovery threatened to escape institutional control. During that period, confidence deteriorated as participants recognized that the volume of outstanding claims on silver far exceeded readily available supply, and that delivery pressure, even if triggered by a minority of holders, could destabilize the entire structure. Regulatory responses were swift and decisive, including changes to margin requirements and trading rules that effectively curtailed participation and forced liquidation, restoring nominal order at the cost of credibility and long-term market participation. While the surface narrative framed these measures as necessary stabilization, the deeper consequence was the reinforcement of a system increasingly reliant on administrative control rather than organic balance between supply and demand. The lesson from that episode is not that price spikes are inherently unsustainable, but that systems designed for stability under normal conditions can become fragile when confronted with sustained, non-speculative demand for physical settlement. What makes the present moment particularly instructive is not the similarity of price behavior, but the similarity of underlying mechanics, even as the actors and constraints have changed. Then, as now, inventories were drawn down quietly before stress became visible in price, and early warnings were dismissed as exaggerated or alarmist until intervention became unavoidable. Confidence persisted, not because risks were absent, but because participants believed that authorities retained sufficient tools and flexibility to manage outcomes. That belief held until it no longer did, and when it failed, adjustment occurred rapidly and unevenly, redistributing risk and losses across participants who had assumed continuity. The relevance of this historical comparison lies in the pattern it reveals rather than the outcome it produced. Systems built on leverage and trust tend to obscure stress until thresholds are crossed, at which point responses become reactive rather than proactive. Early signals, such as declining registered inventories or widening spreads between physical and paper markets, are often rationalized away as temporary or technical, precisely because acknowledging them would require questioning the stability of the broader structure. Yet, it is these early signals that institutions with the most at stake monitor closely, adjusting behavior well before narratives shift in public discourse. This brings the analysis back to the present, where the actions of major banks appear less anomalous when viewed through the lens of pattern recognition. The move into physical silver near current price levels aligns with a familiar sequence in which participants with the greatest exposure seek to reduce reliance on structures showing signs of strain. The question that now arises is whether the pressures facing the modern silver market are simply another cycle that can be managed through conventional tools, or whether the constraints unique to today's environment fundamentally alter the range of possible outcomes. A question that becomes increasingly difficult to ignore as stress accumulates. What ultimately distinguishes the present environment from earlier episodes of stress is that many of the stabilizing buffers that once absorbed shocks have been steadily depleted, leaving the system far more sensitive to changes in behavior than headline metrics suggest. In previous cycles, rising prices could draw out dormant inventories, dampen industrial demand, or incentivize rapid increases in mine supply, restoring balance before structural strain became unmanageable. Today, those mechanisms operate with far less elasticity. Registered inventories represent a shrinking fraction of total claims, and the metal that remains is often already encumbered by prior obligations, long-term contracts, or strategic reserves that limit its availability for immediate delivery. This erosion of optionality means that when pressure intensifies, it is not dispersed across a broad base of supply, but concentrated into a much smaller pool, magnifying the impact of incremental demand for physical settlement. Industrial dependence plays a central role in this shift. Silver is no longer merely a cyclical input whose usage can be dialed down temporarily without consequence. It has become embedded in sectors that governments actively prioritize, including energy transition infrastructure, advanced electronics, medical technologies, and transportation systems. These applications are not discretionary in the traditional sense, and substitution options remain limited or technologically immature. As a result, rising prices do not automatically translate into proportional demand destruction, particularly in the near term. Instead, they increase the urgency with which industrial users secure forward supply, reinforcing pressure on inventories rather than relieving it. This dynamic fundamentally alters the feedback loop that markets rely on to self-correct, replacing gradual adjustment with a more brittle equilibrium. On the supply side, the constraints are equally binding. Years of underinvestment have left the mining sector ill-prepared to respond to sustained deficits, and the structural realities of extraction limit how quickly output can be expanded, even under favorable price conditions. Declining ore grades increase costs and extend development timelines, while regulatory, environmental, and social considerations impose additional friction on new projects. Recycling, often cited as a counterbalance, remains a secondary source that responds slowly and unevenly to price signals, unable to compensate for large-scale shortfalls in primary production. These limitations mean that the supply curve is far steeper than it once was, and that higher prices do not guarantee timely relief, particularly when deficits are driven by structural rather than cyclical forces. Geopolitical fragmentation compounds these challenges by constraining the flow of metal across borders and undermining assumptions embedded in global pricing mechanisms. Strategic accumulation by sovereign actors, export restrictions, and localized resource policies reduce the share of global supply accessible to open markets, effectively shrinking the universe of metal available to settle claims. This trend weakens arbitrage channels that once allowed shortages in one region to be offset by surplus in another, increasing the likelihood that stress in a single node propagates through the system. In such an environment, price signals become less informative, as they reflect not only supply and demand, but also access, control, and strategic intent. Against this backdrop, the behavior of major banks appears less as an outlier and more as a rational response to a deteriorating risk landscape. Institutions that once relied on derivatives, internal netting, and historical settlement patterns are now reassessing the reliability of those tools in a world where physical availability can no longer be taken for granted. Their move into physical silver at elevated prices reflects an understanding that paper exposure carries asymmetric risk when delivery becomes uncertain, and that the cost of securing metal today may be trivial compared to the consequences of failing to deliver tomorrow. This is not a shift driven by optimism about price appreciation, but by a recalibration of downside risk in a system where confidence is becoming increasingly fragile. The implications extend beyond individual balance sheets to the functioning of the market itself. As more participants seek to reduce reliance on paper claims, the burden on remaining inventories intensifies, accelerating drawdowns and reinforcing perceptions of scarcity. This feedback loop can transform precautionary behavior into a catalyst for broader instability, particularly when actions taken to manage risk collectively undermine the assumptions that underpin the system. The near-term window in which these forces converge is shaped by contractual cycles, reporting thresholds, and regulatory timelines that compel decisions at specific moments, reducing the scope for delay or discretion. As these moments approach, market behavior tends to shift from coordination to competition, with participants prioritizing their own security over systemic balance. Responses become reactive rather than measured, and official reassurances struggle to regain credibility once confidence begins to erode. The unresolved tension now facing the silver market is whether this convergence of structural constraints, industrial dependence, and defensive behavior can be navigated without triggering a broader loss of trust, or whether the very measures taken to contain risk will hasten the transition from latent stress to overt disruption. As these pressures transition from abstract risk into operational reality, the defining feature of the current silver market becomes the absence of meaningful flexibility at the margins. Near-term stress does not require a dramatic headline or a sudden shock to materialize. It emerges organically when delivery schedules, inventory classifications, and contractual obligations intersect in ways that leave participants with limited room to maneuver. In such conditions, outcomes are dictated less by policy intent or coordinated intervention, and more by the arithmetic of what exists versus what has been promised. This distinction is critical because it explains why behavior is shifting quietly but decisively among institutions that cannot afford to be caught on the wrong side of a settlement failure. The system does not need to collapse outright for risk to become unacceptable. It merely needs to approach a point where optionality disappears. As the near-term window narrows, the actions of market participants increasingly reflect defensive positioning rather than strategic expression. Banks, industrial users, and sovereign entities are responding not to forecasts or narratives, but to constraints that cannot be negotiated away. When inventory levels approach thresholds that historically signaled stress, and when the proportion of claims relative to deliverable metal becomes uncomfortably high, participants are forced to choose between absorbing higher costs today or risking far greater consequences tomorrow. In this environment, price becomes secondary to certainty, and access to physical metal takes precedence over efficiency or yield. This shift fundamentally alters market behavior, as decisions once optimized for profitability are now driven by risk containment. At the same time, public discourse continues to emphasize liquidity, resilience, and the capacity of established systems to adapt, often overlooking the difference between financial settlement and physical fulfillment. Liquidity in a derivatives market can persist even as physical availability deteriorates, creating a misleading sense of stability that holds until delivery demands rise. Similarly, assurances that alternative mechanisms or emergency measures can bridge temporary gaps fail to account for the cumulative effect of repeated interventions on confidence. Each instance in which financial settlement substitutes for physical delivery reinforces the perception that claims and assets are no longer equivalent, a perception that, once established, is difficult to reverse. The gap between narrative stability and structural resilience thus widens, increasing the risk that adjustment, when it comes, will be abrupt rather than gradual. Misconceptions endure in part because they rely on historical precedent without accounting for how conditions have changed. Arguments that rising prices will automatically restore balance underestimate the time required for new supply to materialize and overestimate the willingness of essential users to reduce consumption. Assertions that regulatory or administrative measures can indefinitely suppress volatility ignore the fact that such measures do not create metal, nor do they eliminate the need for delivery among participants whose operations depend on physical inputs. The market can absorb these inconsistencies for a time, but doing so requires ever greater reliance on trust, a resource that erodes when outcomes diverge from expectations. Viewed through this lens, the current movement of major banks into physical silver near elevated price levels appears not as an anomaly, but as a rational response to an environment in which the cost of being wrong has increased sharply. These institutions are not signaling optimism about silver as an asset class. They are signaling caution about the mechanisms that have historically governed its trade. Their actions suggest an awareness that once confidence in delivery weakens, restoring it may require far more than incremental policy adjustments or temporary incentives. Instead, it may demand a reconfiguration of how value is established and obligations are honored within the market. The broader implication is that the silver market may be entering a transitional phase in which physical constraints exert greater influence over price discovery than financial abstraction. As access, priority, and reliability become central considerations, conventional indicators may lose relevance, and volatility may increasingly reflect competition for scarce resources rather than shifts in sentiment. This process does not unfold in a single moment, but through a series of adjustments that gradually redefine norms and expectations, often becoming obvious only in hindsight. The questions that remain are therefore less about immediate price targets and more about systemic endurance. How long can a structure built on assumed liquidity function when underlying scarcity becomes increasingly difficult to conceal? And what happens to confidence when participants begin to question not the valuation of silver, but the credibility of the promises attached to it? These are questions that will shape market behavior well beyond the current cycle, and they underscore the importance of understanding developments as they evolve rather than waiting for confirmation in headlines. For those seeking to stay ahead of structural change, continued engagement with these dynamics and careful attention to early signals may prove far more valuable than reacting once the adjustment is already underway.